Research at Citi, Markets Edition.
I'm Scott Chronert, head of U.S. equity strategy at Citi Research. Welcome to Research at Citi, Markets Edition, covering various topics at work within the U.S. equity markets. With me today is Drew Pettit, my colleague here on U.S. equity strategy, and we're here to talk about bubbles. The bubble conversation has been coming up persistently in client conversations and in other financial media components in recent weeks and months. This is not a surprise. Over the past 2 years, the NASDAQ 100's run roughly 130%, with the S&P up close to 90%. And what's happened with this is an extended valuation circumstance where we're looking at trailing PE for the S&P 500 that's approaching 25, if not 26 times, and about 23 times forward. So this notion of bubble has been with us, and it relates back to a number of aspects within U.S. equities, led by the AI component that has this infrastructure building dynamic that has been at work, characterized by the Mag 7 as well as other components within this. So to level set and to start, I think what is important is to identify exactly how we think about bubbles. Drew, give us some insight here. How do you think about a definition for a classic stock market bubble?
Yeah, it's funny. I don't like doing this normally, but I'm going to read the definition you get if you just search this. It's a bubble is a market phenomenon where asset prices surge rapidly to levels far beyond fundamental value, creating an unsustainable situation that eventually bursts. So again, bubble, almost like filling a balloon, bursting, popping it with a pin. But I'm going to kick this back to you, boss. This is our definition, but what was it like actually working through and living through one? How did it feel different? What was your experience?
Yeah, Drew's going right after my age, and a reminder that I was in the equity market trenches back during the tech bubble boom. And what I would say very simply, high level on this, is if that was a bubble then, this is not that now. And it kind of comes back to our ongoing view that we don't think at current phase of the U.S. equities, we're in a bubble situation. Back then, yes, we were building out internet infrastructure. This time we're building out AI infrastructure, if you will. Back then, more of the funding for the build out came from either IPO or debt raising. Okay, we had a swath of new companies come into the fray that were all part of this bubble dynamic. Importantly, though, those companies were doing business with each other, i.e. they were each other's form of revenues. That's not dissimilar to what we have going on right now. But again, to my earlier point, the nature of the funding that supported this revenue came from a different place. We were looking then at many business models where companies were not projected to demonstrate positive cash flow over the ensuing 5, in some cases 10 years. So back then, the valuation premise for many of these bubble-esque companies was predicated on a terminal value that didn't relate directly to current cash flow conditions. So you see where I'm going with this is that back then, yes, interrelatedness between the companies similar to now. Back then, the funding that supported the revenue growth between these various providers, a little bit different place. And then lastly, actually getting those companies to earnings, if not cash flow positive, was a different storyline. So it didn't take much back then for the fundamental circumstance supporting all these companies to unravel, as they were struggling to demonstrate revenue growth off of the investments and so forth. This is a much different setup where we're looking at your mega cap growth cohort that is awash in free cash and is able to fund much of the CapEx expectation out of free cash. And I do think that that's an important determinant. Bottom line here, when we think about bubble, everyone wants to go to this point of when does it burst? And our point is it doesn't have to burst so long as fundamental tailwinds are at place. As long as you see CapEx for this cohort of companies growing as it's expected to out to the end of the decade, as long as we see persistence of fundamentals, either via earnings or cash flow, the bubble analogy needs to be put in its own place. Now, Drew, when we go back and then we kind of dive into this, right? And we look at the AI components, we've talked about this ad nauseum. Give us some perspective from your perch on the work that you've done in terms of how we think about the setup here in a more traditional underlying fundamental and valuation context.
Yeah, it's funny. So you hit the nail on the head on the fundamentals and the growth trajectory. We think that's positive. We think that's healthy. I'm not going to beat that to a pulp. But then back to bubbles, it's funny. The reason we're getting the question, it's not really valuation. We're getting the question because the price action has moved so much. Prices have gone up so much since the April lows. But when we stop and kind of remove ourselves from just price, the compares that we've been doing have been on valuation. And look, forward PE for AI names, it's high. It does not compare to what we saw for the S&P 500 growth or the NASDAQ during the tech bubble. So the PEG ratio, so that's taking the price earnings ratio and comparing it to the forward growth ratio, that actually looks like the broader market for AI. During the tech bubble, completely disconnected from the broad indices. Negative earners, we think that does matter even when you're thinking about valuation. You have less than 10% of companies in our AI universe that aren't posting positive earnings. That was over 35% during the tech bubble. And then the last thing, the market pricing in growth, what it expects versus what us human analysts expect, they're actually really comparable for AI stocks today. That disconnect was massive in the late 90s. So when you put that all together, when we think about potential red flags, there's really only one on our checklist, and it's the amount of value that the market is ascribing to this future growth for AI stocks beyond what the economy is going to grow. That is about the only red flag popping up in our valuation monitor right now. So one, maybe 1.5 red flags on valuation in bubble concern versus 5 very bright red flags if you were to do this in the 90s. And honestly, even in the post-pandemic rally period as well. So if I'm going to compare and contrast on the valuation side, we're not there yet. No bubble yet.
Okay, so just to kind of pull this back to center then, where we're going with this in terms of our view, you're going to hear us talking about persistence of fundamentals and magnitude of fundamentals. This is how we're thinking about this, right? So it's not the bubble circumstance that's the issue as much as it is the ability of fundamentals to, over a longer and protracted time frame, support the price action. And that's where we're digging in. We think we're still in very good shape in that regard. Now, this isn't to dismiss the circumstance where there are going to be certain companies, to Drew's point, that are out there in a sort of a different world in terms of what the market is implicitly discounting. So where we come full circle on this, when we think about how to position against this bubble concern, we've developed an approach here that allows us to look at AI, but through a GARP focus. And Drew's done the heavy lifting on the work on this. Drew, do you want to dive it for a moment into our AI at a reasonable price component of this?
Yeah, so GARP, we always love acronyms in finance. So growth at a reasonable price. What we're trying to do here is figure out what the market is pricing in for all the underlying stocks. And then we want to invest in the companies where consensus estimates are similar or higher than what the market has priced in. In high level, when you do that, you are still going to be buying over half of the AI universe. So to us, over half of all the stocks in AI are reasonably priced on this GARP approach that we think is a great way to position the core of your portfolio as we go through this unfolding tech innovation phase.
Gotcha. Okay, so to wrap it up as we hit our time on this, and we could go on for hours on the topic, at very high level, our perspective is, yes, we understand the valuation issue. We understand the bubble conundrum. We don't think we're in a classic bubble bursting environment, as we still think the underlying fundamental trajectories for these companies are in very good place. And it's going to be this persistence of fundamentals and magnitude of expectations over shorter time frames that really are going to define the volatility one should expect about this. But all told here, again, the high level view from our perch, keep a focus on fundamental trajectories before you get concerned about bubbles popping. We think it's premature for that. We do think that there are approaches to investing in this cohort of companies where we pull in our AI at a reasonable price approach, and we can leave that for an outside conversation. But all told here, when we think about the equity backdrop, we think about the fundamental progressions from here, looking for accelerating growth in 26 over 25 and potentially beyond. Yeah, we appreciate the bubble conversation. We're not there at this point. We want to maintain a more constructive structural view towards the S&P in particular, predicated on where we think the productivity components of the AI build-out are ultimately going to take us. This podcast was recorded on October 27th, 2025. Thanks for joining today, and be sure to be on the lookout for our next Markets podcast featuring our colleague Dirk Willer, Citi's head of global asset allocation. And be sure to watch for our Research at Citi podcasts, which you can view on the same channel. Thanks, and have a great day.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.